African economies look up to DFIs led by the African Development Bank and other continental and regional institutions to lead this fight for development and fight against poverty. On its part, Kenya's economy has recovered steadily from 1.6% in 2008 to 4.6% in 2012, and we expect a growth of 5.6% this year, rising to 7% in the medium term, and to double digits by the end of the second medium-term plan in 2017. This growth has been as a result of efforts to anchor economic stability through sound fiscal and monetary policies, and also market-oriented structural reforms. Inflation has been contained, foreign reserves are on the rise, and our public debt profile has improved. Similarly, financial inclusion has improved, with about 67% of our population having access to formal finance, thereby giving millions of Kenyans a stake in the economy. The financial services sector has developed significantly in recent years, buoyed by financial innovations and sound regulation and supervision. Financial sector plays an important role in Africa's economic development. Better developed financial systems mostly captured by depth and efficiency are associated with faster economic growth. Kenya's financial sector is relatively stronger and has the potential to contribute much more to the achievement of sustained broad-based growth and poverty reduction. It is in this respect that the government of Kenya expects a strong and vibrant financial system to play a critical role in the Vision 2030 blueprint for its development. This Vision 2030 targets achieving economic growth of 10% of a sustained period. The reforms we are implementing under financial services are aimed at increasing access, improving efficiency, and enhancing stability. We have recently initiated specific reform measures to achieve these objectives and to strengthen the financial sector to include new and revised legislation on national payments, to include new institutions like the deposit protection, revised deposit insurance protection, to amend laws in capital markets, to revise the laws in insurance and retirement benefits. We have improved credit referencing regulations to enhance credit risk management in line with Vision 2030. We envisage Kenya to be a regional financial hub, and it is our intention to make Nairobi an international financial center. Kenya has a diversified economy with business and investment opportunities in tourism, agriculture, industry, transport, and infrastructure, and also including key strategic sectors like manufacturing, ICT, energy, and construction, among others. The core mandate of the 5 Kenyan development financial institutions cut across all these sectors of the economy, and therefore give great opportunity to support the growth of these sectors. However, Kenyan DFIs have faced a number of challenges in meeting their core mandates. Kenyans DFIs were very successful during the first 2 decades after independence, because they operated under a regime of foreign exchange and price controls which conferred them a monopoly position in the long-term credit market. The 5 DFIs performed well in delivering their mandate and making valuable contribution to the growth of the private sector and the overall economic development of the country in those 2 decades. Since the mid-1980s, the performance of the DFIs has not been strong enough to make them meet their core mandates. And some of the DFIs have managed to tag along, largely because government subventions and even budget support has been available, while others have performed better but have remained small relative to the mid-size of commercial banks and other African DFIs. Overall, the weak financial conditions have made it difficult for some of the DFIs to mobilize resources from the market or from development partners without guarantees from the government. The main causes of the inadequate performance of the Kenyan DFIs have been established as follows. First, the operations of some of the DFIs have been characterized by interventionist business model, which has limited the ability to operate viably in the current liberalized environment. This business model is no longer appropriate, or even viable, or even sustainable. Second, the DFIs, the Kenyan DFIs, have lost the market monopoly position for medium and long-term credit following emergence of commercial banks and other non-bank financial institutions, those that are strong competitors and that are able to offer innovative financial products. Third, poor corporate governance and political interference in the past that often left the DFIs with weak management and demoralized staff, and without autonomy to make sound operational and credit decisions. Those three factors, ladies and gentlemen, are very, very crucial to observe so that we don't repeat history. Although commercial banks and other financial institutions have emerged as strong competitors to DFIs, access to medium and long-term credit and business advisory services to advise the enterprises and industries remain a challenge in certain sectors of the economy, especially in agriculture, energy, infrastructure, and manufacturing sectors. The need for DFIs, therefore, remains very compelling even today. It's going to be also very compelling in future. The DFIs can play a catalytic role and act as partners to banks in the development of the private sector and the growth of the economy by combining public and private resources in effective ways that help address gaps in the market for long-term funds or even longer-term funds. Credit guarantees and even business advisory services is going to be very, very important in their business model. However, for the Kenyan DFIs to be effective development agents, they need to adopt a strategy underpinned by 4 core principles that have been adopted successfully by other DFIs in Africa and elsewhere. These include, first, sound commercial principles. The DFIs should adopt sound commercial principles in order to be profitable, financially strong, and creditworthy for purposes of mobilizing funds in the market on a scale that is needed to support development. Second, they require sound governance. DFIs need to adopt a governance structure that allows their boards and management to operate with a reasonable degree of autonomy and without undue political influence. It should be noted that there are successful DFIs that operate with high degree of autonomy, even when they have perhaps 100% majority, or even when they are 100% or even majority owned by the government. There are examples in Africa. For example, they include IDC in South Africa and BDC in Botswana that I believe are majority owned by the government, but they are very autonomous, they are very effective. Third, range of financial products. The Kenyan DFIs need to offer a broad range of financial products and services that are in demand by their target clients and sectors. Although the DFIs retain an important social mandate, they should not offer products and services that consistently lose money, because doing so erodes their capital base and also impairs their ability to be effective agents of development. Finally, prudential standards and guidelines must be maintained. The DFIs need to adhere to prudential standards such as the prudential standards, guidelines, and rating systems that AADFI has adopted, and this is going to be important to govern their future operations. Ladies and gentlemen, the government of Kenya has taken steps to entrench the above principles in our DFIs by undertaking reforms of the DFIs. The reforms have included a review of the governance structure of DFIs in order to entrench good governance and autonomy. In addition, the National Treasury has been following up with the DFIs to ensure that they adhere to the PSGRS. As of now, all the 5 DFIs have completed and submitted their current PSGRS returns to AADFI. These PSGRS, that is the rating systems, were developed by AADFI as a means of ensuring that all members of DFIs are governed by the same standards. However, there still exist gaps in terms of regulation and supervision of DFIs across the continent, with individual countries employing different mechanisms. Some countries have given the regulatory and supervisory role to their central banks. The situation in Kenya is a bit different. Our DFIs are not regulated or supervised by the central bank. However, as part of the reform agenda, the government has developed a draft DFIs bill that will be gazetted soon, and which will see the DFIs regulated in a prudential manner. But there are challenges, ladies and gentlemen, facing DFIs across the continent, and those challenges are largely similar. Central among these challenges is the low access to financial resources in the magnitude required to enable DFIs to play a development role that they were established to undertake. Some of this funding are expected to come from government, but governments cannot continue funding DFIs due to competing demands for those fiscal resources. Support to DFIs is thus contingent upon delivering their mandate and not funding activities that can be funded by private financial services providers. It is notable, however, that there are success stories among African DFIs that can be emulated and replicated. It is my sincere hope that this forum will expose the less successful DFIs to learn from their counterparts the specific models that should be adopted to achieve the measurable success that is required. Finally, I would like to urge the Association of African DFIs to continually review the prudential standards, guidelines, and rating systems, that is the PSGRS, and benchmark them with similar standards from other regions, particularly in Europe, in the European Union and Asia, where DFIs have had significant contribution to development of those regions. It is important that we seek to emulate good practices as we strengthen our DFIs. Let me conclude by wishing you fruitful discussions and a pleasant stay in Mombasa. I hope that you'll find time of your busy schedule to sample our tourist offerings in the coast of town, which is very rich in both Swahili culture and tradition. Asante sana. Thank you very much. Thank you very much for being a good man.
Thank you very much. Before we go out to take our group photograph with our invitees, I will once again request you to give a round of applause for the brilliant speeches we have heard over here.